We've got another informative week coming up with the top-down macroeconomics likely to be every bit as important as the bottom-up micro company news. This is because we've got UK inflation figures on Tuesday the 13th of December, the latest interest rate decision from the US Federal Reserve on Wednesday the 14th, and the latest announcement on interest rates and quantitative easing from our very own Bank of England on the 15th. The market seems to reckon that the US Central Bank is a certainty to raise interest rates by a quarter point to 0.75%, the second hike of this cycle and the first since last December. There also seems to be a similar consensus that the Bank of England will do nothing. On the company front, 4 FTSE 100 firms have got scheduled statements, including interims from Dixon's Carphone on the 14th, a trading statement from Utility Centrica on the 15th, and full-year figures from leisure giant Carnival on the 16th. But, for me, the release that is most capable of causing a fuss in the week ahead is the first half set of numbers due from Micro Focus on Wednesday the 14th of December. The Newbury headquartered firm provides software and consultancy services to companies who are running and updating legacy software systems to more modern technology. Now, it might not sound very thrilling, but the focus on legacy product means Micro Focus offers expertise that can be hard to find in areas like COBOL, and that provides a huge install base of license deals and a good flow of dependable maintenance revenues from sticky existing customers. Management's been particularly good at efficiently managing the legacy business for cash and recycling those readies by investing in products for the future, either organically or by acquisition. This is a high margin business, and high margins can mean good cash flow, and good cash flow can mean healthy and rising dividends. That's why the stock's done so well over the last 5 years, and it joined the FTSE 100 after the Japanese takeover of Arm Holdings just this summer. Now, the numbers aren't always the easiest to understand because of the acquisitions, and the company is in the process of digesting the US company Serena. For the full year to April 2017, analysts are looking for a 7% increase in earnings per share, so that seems like a pretty fair benchmark for the first half set of numbers. In the first half a year ago, sales were $605 million, stated pre-tax profit $98 million, and the dividend 16.94 cents. Again, the shareholder payout is expected to grow. Keep an eye on the mix of revenues and growth across licensing, maintenance, subscription and consultancy revenue streams. Also watch net debt, which ended the last financial year at $1.1 billion. As a final point, Micro Focus is in the process of merging with the software assets of American IT giant Hewlett-Packard Enterprise, and the $8.8 billion deal is easily the biggest transaction the firm's ever carried out. The merger, is expected to go through in the second half of 2017, and it will leave investors in Micro Focus holding 49.9% of the shares in the new company, which will be run by the Micro Focus management team of Executive Chairman Kevin Loosemore and Chief Financial Officer Mike Phillips. HPE's latest set of results released in November, well, they look solid enough, and it'll be interesting to see if Loosemore is able to say anything further on the deal as he prepares for completion of the transaction. Thank you for watching, and I look forward to seeing you next time.